Hello, folks, and welcome back to another episode of Cambro Conversations. And today we are joined by Aaron Knightley of Knightley Investments, and we're going to be speaking about what can we learn from high net worth investors that we can implement for ourselves. Aaron, welcome to the podcast.
Cheers, Colin. Thanks for having me on. Looking forward to it.
Yeah, it's another one of these introductions through my online network, and that's part of the reason I've loved doing the podcast and doing Instagram over the last few years. Before that, you can meet like-minded people, interested people, albeit people with different expertises from myself, and that's the beauty of it. So delighted to have you on, Aaron. And for the listeners, do you want to give a little bit of a background, as all good podcasts start with, on yourself?
Yeah, sure. Yeah, so Knightley Investments, Knightley Investment Group. Obviously, in the title there, we deal in investments, but background, real sort of summary, not to bore you too much. Came from logistic background, hardworking family, very much from ground up, and throughout sort of going through logistics, your employed role. Started to get a spark, was given a few good opportunities when I was younger, about sort of seven. Well, the first opportunity came about sort of 7-8 years ago.
Yep.
Which was in property. That sort of sparked the whole journey to where we are now. But from the young age, I certainly went from a job to a job to a job, which really now in hindsight, and with other information that comes to light now with a lot of young entrepreneurs, is that might just be a sign that maybe you don't want to settle for one particular thing. So from the background, I tried many different things, from converting trailers to an eBay shop, which I ran for quite a while, went quite well. It wasn't really for me. It was good. So I tried a lot of different things. And then again, later in life, was offered an opportunity through an old partner who was into property. And then through sort of the journey through property, where I ended up involved in a couple of projects financially and actively, which led me into basically the role of diving into investments and finding a bit of a niche within the numbers, the raising of equity, dealing with clients, and just learning to love it and then adapt to it. Education came along, and here we are today. So, we're still learning, we're still moving forward, and it's a good journey that I'm on at the moment.
Yeah, of course, Aaron. I've been consuming your Instagram content since previous guest of the show, Justin Wilkins, introduced us. And investing, something that I've had a focus on in the last 4 to 5 years. I'd saved for a property. I made my first purchase last year, but ultimately I wanted to make my money work harder for me when I was saving than just the cash ISA, which was getting 1% interest when inflation and everything else is going up in price. So you're actually losing money by saving money, which for some of the listeners, that'll sound horrific. But if you look into it, that's absolutely the case, unfortunately. So I started to get involved in things like stocks and shares and assets as well. And that's why when Justin was like, "Oh, you should have a chat with Aaron," my eyes just lit up, and I was like, absolutely, because if me as a 27-year-old 9-to-5 career-focused worker, many of my audience, very like-minded, they will want to talk about this as well, and that's where this episode's gonna go, really. So what does Knightley Investments do? Who are your clients, and what are some of the things that you get involved in on a daily basis?
Yeah, so it's Knightley Investments because unfortunately that's all that Instagram would allow me. So it's Knightley Investment Group, which allows us to cover all different areas. It doesn't tie us down to a title of one particular area. And it's good to know, actually, you're 27, I'm 27 myself, so great age. But yeah, so what we do essentially is we are investors. We're investors as a family, but I'm also an investor with my family that I have myself.
Yeah.
My wife and I, and that can be, well, it certainly was in the beginning. I dipped and dived into stocks and shares. As we spoke about previously on the phone, is stocks and shares is a very interesting area. So I sort of dibbled and dabbled into that, and I suppose I got lucky. Like I've said it on other calls, I just got lucky. I purchased some early stocks into a mining company, which I saw a lot of good press about, saw a lot of forecast
Okay.
when I was younger, and that's how I started in stocks and shares. I've always been a saver. So from the age of 15 and 16, I've saved. I think, that was a big bonus for me. Is I've always been a saver. I've never been a spender. So I had some capital to start with of my own. I got lucky. I thought I was an expert in the stock market. So I thought I'm onto one here, and I liked it. I think everyone likes investing. I think they'll like it. They just don't know about it. And when they find out about it and they educate themselves and they start playing with it and they see a bit of return, I don't know anyone that wouldn't like it. So people end up liking it. So I really liked it. And then the whole education started. So I was investing in stocks. I did a couple of really small projects of my own. And like I said, that was from just buying trailers, like horse trailers, converting them. We did some smaller trailers. So stuff that was making like quick turnaround. So I liked the idea of using the money that had been saved to try and do quick little projects, quick turnarounds to see, like we bought a couple of cars and we did minimal to the cars and we sold a couple of cars, just really small things. And then really I was given a couple of opportunities. I took them where I had to raise quite a bit of my own capital, where I borrowed from family members and so forth. And that really was then the whole propelling of, I like investments, and it wasn't a case of the knowledge was all there at the time. It's just that I knew I liked it. I knew I liked property, although property is not a main focus for mine now, but it certainly was to begin with, because I think that sparked me off to think, oh wow, there's a lot of money here to be made.
Yeah, it's a good grounding for you to start with. And then, like you say, you had the stocks and shares interest, so you already started to build that diversity of interest within your investment portfolio, which we'll get on to, is incredibly important, isn't it?
Yeah, it is. So that's where it started, really, was with the stocks and shares. But we'll just jump right into it before we go into it in more detail. Is that now we're in a position now where, because of some good choices, now we can actively invest in different areas. And the education is a huge part of that, because if you don't know something, you're not going to know about it. So when you start to inform yourself and you start to really commit some time in learning about all the different avenues, you start to see that, the whole compounding effect isn't necessarily one avenue. It's not necessarily the compound effect through property. If you combine 4 or 5 areas of investment, even if it's on a small scale, you don't even have to be investing a lot, but the returns on a 4 or 5 avenue compound effect is going to be a lot. So that's where we are now. We actively invest, more of an armchair role, and that's essentially what we do. So I'm just always looking for new opportunities, and that's what we do today.
Yeah. What are some of the projects or opportunities that you kind of hinted at? What's like a kind of concrete example for anyone listening that's thinking, okay, that sounds interesting. What does that actually mean to the layman?
So again, it all ties into allocation. So I've always been a saver. So I've already been really strict with my funds. So, probably more than the norm, but everything has an allocation and everything has a certain amount. So, we'll have our biggest allocation into, as one of my recent posts, into fixed investing. It's one where we can really compound pretty hard. And it's one that will generate the biggest pot of wealth. Then we'll have a smaller pot, say, for some of the local guys who we know really well. Let's say if someone said, look, we've got a refurb, we need some funds for 4 or 5 months. We know them personally, we know their track record, we like the project. That's a smaller fund allocation, but we know we're going to be getting almost like a split or a good percentage of what we're going to be lending out. And then we'll have other allocations for commodities, for stocks and shares. Although we don't single pick anymore. I used to. I don't do it anymore. So more now we just put into a Fidelity fund. And so everything's really managed. And, I review everything sort of every three months. I've only recently changed our allocation because I personally think we're going to see some rocky movement in the stock market. Gold's You might have seen in the news, gold's coming up to an all-time high at the moment. I know where I want to be with our commodities. So yeah, the biggest allocation would be in fixed. And like I said, my recent post kind of gives everyone a good visual breakdown.
Yeah, I like that idea of a diverse portfolio with allocations of money being invested into different areas. In terms of a fixed, what does that necessarily mean? So you told me about it on the phone the other day, and I was becoming educated, as you said. So let's educate the audience as well.
Yeah, so fixed investing can be through all different areas. For us, it's through big scale property development. So a big national company, a big corporation that is taking on large units, really big sites, and they're developing out, and they're doing multiple sites. And what you can do is you can invest bigger allocations of funds, and you can reduce and mitigate your risk because you're not investing into one sole project. And if that one sole project does not return what it was forecasted, or the company folds, or there's a problem, the market drops, your money is a result of that land and that project. So your hands are tied. With fixed investing into big corporations, you can take essentially company charges across multiple assets. So if one area of the company isn't performing, there might be 3 or 4 other outlets that you can draw down on.
Okay.
And they will offer, because of the high returns, they will offer a fixed return because of the money that you're going to be investing. So fixed investing, really, it's just day one, you agree your return. It's not a joint venture. You invest this amount. It will be a minimum that you have to commit. And you'll have to certify, like I said, as a high net worth or a sophisticated investor. You know what you're going to be getting day one, and you know the exit. So it's very clear. That's why it's fixed. There's nothing, there's no hurdles. There's no joint venture. You're not in partnership. You put it in, you're going to be getting out what you get. But with every reward, there is a risk. I could lose it all, but you calculate it. It's planned. You know the insides of what's going to happen. So it's as comfortable as we can feel. That's what fixed investing is.
Yeah, I understand that, Aaron. So, for example, if you're talking about large property projects, you've got your high net worth clients who go along with the process and the different allocations which you set up. They maybe put their money into a fixed, which might be developer X, who's building 5 sites. 2 of them are resi for houses, and 3 of them are office or recreational, whatever. And you know that'll return a fixed percentage based on their guarantee. Would that be a fair summation?
Yeah, so there's no guarantee. So there's different terms you could pick depending on what client you went with, or what your needs were, or what your preference. Because also you can choose from there are a select few returns that you can pick, which will then balance up to the amount of security that you can take. You could pick from, say, an 18-month product. You could pick up to a 2-year, to a 3, all up to a 5-year, where it's a rolling compound product. So it's down to the investor that chooses. But essentially, whatever they choose, it's agreed, legal paperwork, signed off on certificates, that this is what you're going to be putting in, this is what you're going to get out. However, there's no guarantee, because when we're looking around some of these companies that are folding, not in a million years would you ever think that, you would think they had roots all the way to the center of the earth. But turns out a lot of these companies don't, and they're not financially liquid, so they can't bail themselves out. So nothing's guaranteed, but we've got enough proof in the pudding that enough investors are happy. We're all being paid. We've all been paid. We're continuing to be paid. And a lot of our clients that I'm still working with, I'm proud to say that a lot of them have performed really well throughout COVID-19, which is going to make me, again, recycle my funds. And I'll keep it as my biggest allocation, as I'm sure many of my investors will and have been doing through this last 3 months.
Yeah, I think a point to clarify then for the audience, and obviously my own understanding as well, is your clients are certified high net worth. What does that mean in the most basic of terms?
Yeah. So the average day guy and girl walking along the street is likely to be a retail investor. So
Yeah.
you're still investing, but you're not certifying that you have X amount of assets in the background, and that you're turning over X amount as an income per year. So your high net worth, would be turning over that sort of 120 plus K a year, and in the background might have 250 plus K of assets. So that's a high net worth. They have to certify. I have to certify them that that's the case. I need the proof. And then a sophisticated investor is someone that's been working within the equity market for 2 years, or has a company annual turnover of $1 million plus. And that has to be for the last 2 years running. So they have to certify. And the reason being is because a lot of products years ago, even before I was involved in it, I just know it of knowledge, a lot of retail investors were in the market. And that's why you don't see a lot of the investment opportunities that I'm able to access and my clients are able to access, and these big family offices and institutions are able to access, is because they're not on the market. Because as soon as you start bringing in high profile footballers and you start bringing in celebrities and Love Island characters and retail investors, if it all goes wrong, they all throw their hands up in the air and they start screaming and pointing that it's all your fault. So that's why they have to certify. They have to be able to say, I'm willing to take the risk because I want the reward, not the other way around. I want the reward, but I don't want the risk. And if it goes wrong, I'm going to moan about it. It's not like that. You're either in the know and you understand the responsibility, and the reason you need to do that is because that's why you sign the paperwork to say I'm a high net worth or I'm a sophisticated investor. I've proven it. I'm willing to take the risk because I want the reward.
I think that's a really important point to make amongst that, is that with any investment decision, there's a risk to it. So I know from personal experience that when COVID hit, my stocks and shares, which I'd been paying into for 3 or 4 years, which were up about 15-20% across the different investments I had over that period. So fantastic, much better return than I was getting my cash ISA, sorry. But that pretty much was wiped out and went down the way when COVID hit. But ultimately, it's a long-term picture that I'm looking at. Yeah. So I won't be touching that money for 10 years. So I'm still paying in. I'm still buying similar shares, similar stocks, and I'm just letting that accumulate again. So the reward for me will be much further down the line. The risk will be spread across numerous years, which helps to smooth the risk and reduce it over that time. And
the thing, so you've just, and I was going to bring it up. You've just said it. We've got time on our hands. So whether it drops, mine drops like minus 32% when like in the first few days when we went into lockdown, it was like minus 32%. It didn't faze me at all. A lot of these, you listen to podcasts or you listen to YouTube and they're all talking about the financial crash and everything like that. Well, it means diddly squat because I'm not retiring for another 30 years.
Yeah.
So it means nothing because I've still got growth. And although I haven't got much confidence in the stock market over the long term, I'm still going to hedge my bets. I'm still going to be involved because if I'm wrong, I wouldn't not want to be involved. The people who have lost out and a lot of the clients that did approach me during this period was we had handbrakes on at the beginning. We had handbrakes saying, Aaron, let's just pause for a moment. And then it was very much handbrakes off because a lot of these guys, I'd say some of my oldest clients are, late 60s, early 70s. They've been spending the last 20, 30 years building up their stocks and ISAs, stocks and shares, and they may have lost 20,000, 30,000 on their 100, 200K pot. So they've now got to find a way to recoup. A good way of doing that is through fixed investing. So what they do is they go, scrap this, I'm out. They pull out their money out of the stock market and they go, boom, and they go into gold. And then they'll put a portion into gold. They might buy up a couple of properties and then they might put a big chunk into fixed investing because now they're going to try and push for this last 2-3 years before they sell up everything.
Yeah. So very different strategies based on your age. Now, the vast majority of my demographic are 35 and under. And we, like you say, we have time on our hands to try and take some of the principles which your younger high net worth clients have and implement them into our own strategy and make those financial decisions that will pay off in the longer term and will have a reward further down the line. Yeah, listeners of the podcast and followers on Instagram will know that I love the concept of delayed gratification. So a little bit of not pain, but no massive dopamine hit now, for a longer term big hit of dopamine when it all comes home to roost. Some of the things that you do within your business include things like the accountability group. Do you want to tell the listeners a little bit more about what that involves, who's involved with that, and why it's been such a success, particularly during this period?
I will. And if you don't mind, I just want to finish off on a point you just said about delayed gratification, is that that's the hardest part for people to get over, is that the compound effect is proven. It's a blueprint. It works. I think the hardest part for people to get over is to go, I have this pot of money, I want to invest it, but because of social media and the hype of turning millions in tomorrow, it doesn't happen. So they don't like to wait. So the sooner you can get over this whole ego of, Sam down the road is portraying that he's got this Ferrari and, he's living this life and he's done it within a week. They need to let go of that, focus on themselves, and start compounding and start seeing it over 2, 3, 4 years. Because when you start seeing it over 2, 3, 4 years, that's when it starts to come back. And then you get in this recycle of investment. So, it is a time thing. Unless you've got the next £1 billion idea, stick with what works. But yeah, so I agree with that. So the accountability group started off really small. So it's when I used to do more niche phone calls about really niche topics in regards to private investment, just with a select few, 4 or 5 people on a call, which is when I was doing all these little calls and it was taking up quite a bit of time. And I thought, look, I'm just going to stick this into a group, in a WhatsApp group. We can it can be more bouncing back and forth. From there, I think it was just word of mouth, one said to another, this is, group's great, learning a lot, so forth, a few requests, started setting up the weekly calls, and really it just snowballed. But the accountability was set up because from the old school guys and girls who were involved day one in the group, I set up financial challenges for everyone, which we were actually discussing today, and I've actually opened it up to everyone else in the group so everyone can get involved, which is an end of year financial challenge from money management. So everyone in the group now, although already participating some, everyone now has the option to change. Everyone to keep change. So one of the challenges, for example, if you've got a £20 note, you head in, you get some petrol, and it costs you £5, whatever. If you get pound coins, 50p's, coppers, whatever it may be, you don't spend anything. It all goes in a pot. So there was a coin money management target that everyone's got to hit at the end of the year. And then we worked that into the bank accounts, money box, rounding up bank change. So I regularly set challenges where people go, damn, I've actually got to do it because he's chasing me. I've committed to it. I've also agreed that I've got to upload pictures and tag everyone on Instagram and social media. Plus I've all got it on a spreadsheet. It makes it happen. And I have rewards. I buy people books, vouchers, Amazon vouchers as a reward. Yeah. So it's really good.
What are the other main things that the guys are looking to get from the group? Are they looking to get into your sector where they are acquiring high net worth clients that they will provide the investment support to?
No, not so much. So there's no, even from my side, so there's no kind of client or partnership gain. What it is it's to bounce ideas and it's to keep things moving. So as I explained, I know we briefly covered it off. If someone is idle for 2-3 weeks, they're out of the group essentially. Because I'm getting requests constantly about joining the group now, which is great. But I can't bring everyone in because it would become a mass. It would become oversaturated. So yesterday, all 25 of us were having a great conversation about where everyone's putting their money at the moment. We've got people stockpiling cash in ISAs. We've got people who have gone fully into an index fund. We've got people who are just buying gold. We're sharing information, content, little bits of information, finance information. And it's just constantly active, as I said to you, from the moment we wake up to, I think some of the latest conversations we've had have gone midnight. and I'm up at midnight. So it's just active. There's no end goal out of this. It's just everyone's learning, everyone's active. We're pushing Instagram algorithms. We're doing Instagram challenges. It's just a great group to be in. It's just everything, really.
I think in any space you're in, it's great to have like-minded people to bounce ideas off. So it sounds like the perfect way to get involved from an investment, a financial perspective, with an accountability group who are all wanting the same thing, to end up financially free when they're older, when they retire, to know they've got a comfortable standard of living. You touched on it very briefly there about the weekly calls now. So it's Knightley's roundtable calls, isn't it? As it's nicely named. What have those involved, and what have you got coming up? I know there's a couple that I'm quite excited about to get involved for the first time.
So that started from wanting to provide information that was, for me, I've been totally self-taught, and YouTube, as you know, you can't go on YouTube without being bombarded by now 2 ads. It's ridiculous. 2 ads we got to watch now. That's why I pay to now have premium, so I haven't got the ads.
Do you? How much is premium? How much is premium?
£15 a month.
Oh, it's just hold on. I'm going to tell you off. Think of the compound interest on that.
I know, but think of the amount of times I won't throw my phone. That's what
This is true.
So, but no. So there's a lot of stuff on social media and especially YouTube that people. It's great for information, but also everyone's a mentor, everyone's a trainer, and a lot of people do get sucked into it. And we've heard really bad stories of people losing their money. Now, from the angle that I'm coming from, I'm completely self-taught. I have had, I do have people in my life where I can call them, I can ask for advice, I can ask for them their experiences. And I'm very blessed to have certain high-profile people that I can call who have pretty much done everything. But the idea is to set up a group, have guest speakers on in different sectors, just like yourself. You want to cover off different areas on your podcasts. That's exactly it for me, because if we can broaden the mind, obviously everyone can take away and learn. And it was set up through COVID because everyone has the time, and hopefully everyone could hit the ground running afterwards. But it just evolved. It just became really popular. Before I even announced the guests that I have next week, I had 37 people. I had 37 attendees. No one even knew who was going to be on the call. So, it's great. And we're probably going to do 60 plus next week. And it's just about information. It's not about property. It's not about anything. It's covering everything. So people can come away and go, oh, I didn't know that. Oh, I haven't been doing that. Or I should really look into that. Or actually, I didn't collect all my pensions, but now that I know that, I could have that. Or, so it's just to get everyone thinking and come away with a lot of value for free.
Yeah, I love that. Giving value for free puts you in a position as an authority long term, and ultimately it serves you as well, because one of the best ways that I learn something is by teaching it on to others. And I'm sure there's some sort of analysis on how the brain works that will mean that is a good way to learn things. And some of the calls that you've got coming up are quite exciting, aren't they, in terms of one particular author that I've read a book which I think third hand came my way through you, I think, based on a recommendation that you made to Justin that he made to me.
Yeah, I honestly, I can't tell you the amount of people that have read that book. And it is a brilliant book, because if you ever read Benjamin Graham's Investor, Intelligent Investor, I explained it like this. If you have half a clue about investing, you might understand 55% of it. The rest is complete gobbledygook. I mean, I was listening to that in the car thinking, what the hell is this guy going on about? I've not got a Scooby. So it is very confusing. But then go back to How to Own the World, understand every word of it. And that's why it's plain English. And I reached out to Andrew because I knew that it was going to be a huge hit. And actually, one thing that is brilliant, I've read Andrew's ebook, which you can find on his website, The Complete Guide to Investing and Owning the World. Is Andrew now, everyone who purchased it within my group is going to get a free copy of his next book. So Andrew is going to be a guest on the show. He's agreed to that. It's just a timing thing that we're working out at the moment. And obviously he has to be very careful because he's regulated. He just has to kind of really go over my criteria, what I might cover off, and I wouldn't want to ask something and he can't really answer it. So there's just some finer details. There are a couple of really big guests coming up, one in particular which my accountability group know about. They don't know who the individual is. I can promise you now, you're going to go absolutely bonkers when you find out who it is. I couldn't even believe it that I even spoke to him on the phone. So it was insane.
Exciting.
It's going to be great. We've got some great guests coming up, and obviously Mark and Matt for next week.
Yeah, just to come back on the point around Andrew Craig, how to own the world. The whole principle in it is plain English finance. So for me, as a relative newbie, despite somebody that had been investing for a number of years, had a property, wants another property, wants to make his money work for him, and wants to save, it's been fantastically easy to understand, and I've added it to my Amazon shop front, where a lot of people who listen to the pods can go and purchase the books that we talk about. And for you to have him on a call is going to be super exciting, and I can't wait to get involved in that.
Yeah.
So in terms of the real meat and bones of this podcast, we want to talk about some of the principles which your high net worth clients have in place, that you've implemented yourself, that us normal guys who aren't necessarily bringing in 120k salary a year straight away at the moment can implement into their lifestyle. So what are some of the kind of principles that you would start off with?
So yeah, I mean, what I'm lucky is that I was able to learn from family offices, high net worths, and really, because also I'm working with them, I'm able to ask a lot of questions and learn from them. So that is why I've been blessed, is to learn. But I always start, and if you actually go onto my blog page through my Instagram, if you scroll all the way to the bottom, I've got 2 files: money management, and then basically a breakdown of a chart of compounding chart. But I would, the core is having the reserve. So if things do happen, don't invest if you haven't built a foundation. So I run my foundation like this, and any conversations I've had within my group, and there are people that are now implementing it, and they have been exposed during COVID, and a lot of the high net worths, they will start investing into a emergency fund, a reserve, build that up so that it's sufficient. So not necessarily to withstand a pandemic, because you never, it's in a lifetime, you can't plan to or save to have that.
Yeah.
Emergency, and then having I call it a maintenance fund, but you can call it a quick access fund. A fund that you never need to touch your emergency, but if things do go wrong, you've got a frontline defense. Once you have those sorted and you've invested into yourself, saving that, and this is the money that could have gone into that £5,000, £24,000 course that you had, put that aside. Then once you've done that, everything else is investment money. So now you can start to go, okay, where do I want to be? You have to have a good chat with yourself, even at a young age. We got a really young couple in our group. I cannot tell you how impressed I am with one individual. I put up a story about it a while ago. He's already buying gold. This guy's just turned 18. Gold, property, emergency funds done, maintenance fund done. It's done. 18 years old. So I envy him. And once you've done that, that's when you can start to go, okay, where do I want to be in 5, 10, 15, and 20 years' time?
Yeah.
And then once you've made that decision of where you want to go in life, then commit to the decisions and the investments that you need to do. And, we are young, so we can go aggressive. Don't go aggressive stupidly, but go aggressive now so that we're going to see the rewards. Don't think of where you want to be at 30. Do you want to retire at possibly 41 and then have the rest of your life, in the mold, wherever you want to be, wherever? Plan for the long term. And that's what all of these high net worths have done.
Yeah. So borrowing those principles from high net worths, the first one that stands out is that emergency fund that you've highlighted there. So before you start pumping £300-400 a month into a stocks and shares ISA or buying gold at £200 a month or whatever, you need to have the bare minimum that if, for example, you got made redundant or you became ill or unwell and unable to work, you need to have that minimum that will pay for the basics. So it's things like your mortgage, isn't it? Your car insurance, your car payments, whatever it is, enough to eat for a period of time.
Yeah.
And you tick that box. And then the second principle is that next layer, which I loved that you were talking about, the kind of maintenance fund, where rather than having to go straight to the emergency, which is the kind of God forbid situation that you never want to have to touch, you've got this first line of defense, which is again a great phrase that you've used, where if something just a little bit went wrong, so maybe it is you're on furlough for a little while and you're 20% down in your salary, you've got this maintenance fund that you dip into and you can pay off the different things that you've got that are essential. Maybe the boiler breaks down, or what were some of the examples you gave, like you need to get a new washing machine, stuff like that.
Yeah, just everyday life. And I'll give you a bit of a funny story. My wife should have known, to be honest, but one day she rang me and she said, "Oh, just to let you know, I've had to go and buy a new cooker," or it was something big, and she just rang me out of the blue and she said, I've taken it out of our quick access part." So I quickly checked our accounts, and she'd taken it from, because we always keep a portion, you might have some in the bank, you might have some cash, but basically the emergency, not only have we titled it emergency, so it actually says emergency on the account, but then it's got DNT. She never knew what that meant, and that's do not touch. And I looked at the account and I saw this huge chunk out of our emergency fund. I nearly had a heart attack because I've never touched that. I've never touched that in years, and I wouldn't touch it. So that just goes to show you never touch it. It only comes to the point that you have to rely on that. And if you can drill that into yourself, I mean, look, the saying "live on less, save and invest," that wasn't just made up. That's the truth. So once you get those foundations built, then you can really start planning and forecasting. And all of these high net worths, whether they own a business or whether they own a hell of a lot of property, they're using the money. They're not going out and buying. I use this. Anyone who was on my call has heard me say this. One of my, I'd say, in the top 10, one of my most wealthiest individuals walks around with holes in his jeans, hasn't had a new pair of trainers. People probably would look at him and think, come on, buy a new pair of jeans. You can say that, but that guy's never going to work. He's not having to lift a finger. He's a multi-millionaire who turns out something like 4.2 million a year. If he wants to walk around in holes with holes in his jeans, let him crack on, because he's not going to work. So it's letting that whole ego go. I don't know about you, Colin, but I used to spend so much on protein, creatine, BCAAs, pre-workout, all the tablets, multivitamins. And I got to a point where I was just sort of saying to myself, I was in good shape before, I'm just going to stick to some pre-workout and whey, and I'll save myself like £120 a month. It's
that like minimalism principle, isn't it? Where you find the kind of minimal effective dose that was working for you in terms of supplements and what you needed, and you can kind of pull back on the kind of icing on the cake sometimes, and then that money can be diverted elsewhere for the longer term. It's that delayed gratification again, isn't it? Where you're just moving that money further down the line to hopefully enjoy it another time.
Yeah.
We've touched on it a few times, gold. So one of the other things we can invest in is what's called commodities. And that, again, is a fairly new phrase to me. I've never bought gold before. However, I've already been investigating off the back of some of the articles I've seen from you, and also one of the chapters that I read in How to Own the World, because the performance of gold over time is one of the best performing assets that we can put our money into. And ultimately, gold is cash. Maybe stealing some of your thunder here, but gold is cash. And this is some of the stuff that I've learned from you as well. Gold is cash, and it's a hugely significant thing that we can put our investment towards. Do you want to talk to the audience a little bit about that?
Yeah, and what will separate you is ask yourself this question. Some might go, well, if I spend money on gold though, and let's say I physically keep it, I'm not going to earn anything from it, or it's not. I can't do anything with it. I want income. Well, that's great. But it's about diversifying. It's about what ifs. We're all hedging our bets. A pension is hedging our bets. Gold is hedging our bets. But gold is very much proven. Stock market, it's all hedging our bets. But gold is money. So gold is the core. Let's say everything went to pot and we were all trading chickens, right? Everyone's running around. The government's gone. Let's just call it back to BC. Yeah. So we've gone back and government has collapsed. No one's got any pension. What's going to happen? The poor are really poor. So they're going to turn to violence, robbery. It's going to get nasty. It's going to go Book of Eli. I don't know if you ever see that. We're talking like Book of Eli stuff. Well, there's going to get to a stage where we're all advanced enough to know that the economy will need to start again. People will need to earn. Thieves will need to earn. Thieves will need a reward for going and stealing something and then wanting to sell it so they can go get more. Yeah. Well, you can only trade so many cows and chickens to each other until the point where you go, actually, for my 4 chickens, I don't want a cow. Actually, I want something. That will be gold. That will be silver. It is money. That's where society would start again. If it were all to go to ground zero, yeah, gold and silver will be where it will start. So if you have gold and silver, it's liquid. So let's say the stock market crashes, gold shoots up. Okay, by 2030, they reckon by the swings and trends, believe that it could be between $3,000 to $5,000 at an absolute highest per ounce. Okay, that's only in 10 years' time. So that's a great bit of growth. Now, if the stock market does crash, what have you got? You need physical assets. No one's going to take a property off you. And one thing I always say is own a property outright, because if you've got a mortgage on it, you don't own it. If it all goes to pot, the bank's taking it back. You know, so own the property. When you own it, no one's going to pick up a physical building and move it. It's not going to vanish. Yeah. Same for gold. As long as you protect the gold, it's not going anywhere. It's yours. And it is an appreciating physical asset. So gold, you can't really go wrong with. The only thing I would say with gold is, you know, buy in bulk. I wouldn't, there's, you know, cost averaging, you know, like in the stock market, you constantly drip feed. That's great. With gold, you can do that. And like Andrew Craig says, drip feed into it. But what I like to do is bulk buy at certain points. So I have an alert on my phone that every time gold drops below a certain figure, it sends me an email, and then I know to buy in bulk. Yeah. But I only make that decision now every 2, 3, 4 months, perhaps. So gold is the foundation. Gold is money. And without getting into it too much, because we could talk for hours, but the way originally gold worked is that a lot of it is leased out to fluctuate. A lot of it is leased out by these societies and governments to fluctuate, because if everyone turned to gold, it would shoot the prices up and the demand is then high. The government does not want the demand for gold to be high because that's money. There isn't enough gold to go around. Yeah. So we could talk about gold all day long.
Yeah, the demand for gold's going to spike after this podcast, though, Aaron. So we've really fucked up there.
Well, I'm buying.
That's it. Well, I certainly, on reflection, I want to have a more diverse portfolio between property, stocks and shares, ISA, gold, and then we'll explore some other areas as well. One of the areas that hit home when you and I were chatting, but also from the literature that I've read, is the reality of what pensions are going to look like for people that are our age. And some of the statistics are quite incredible. And to give an anecdotal example, the goalposts are moving already, whether people are aware of this or not. Particularly if you're in your 20s, you're in your 30s, you're maybe not aware of this, but already people who are born a couple of years too early or too late didn't get their pension when they were meant to. So I know from my mum that she, I think, will be in her we won't give her age away, but she's in her mid-60s, and because she was born, I think it was 2 years too late, effectively, her pension's been delayed by 5 years. Now, luckily, or not luckily, Dad's able to support her. She's not in a position where she needs the money each week to live. However, there are people who will be in that situation who the government have just decided on a whim, because they can't afford it, that she's not getting her money for another 3, 4, 5 years. And that is an incredible situation, and that's only going to continue when you look at the numbers. And I know you've got some passionate views on this as well, Aaron.
Yeah, so I was actually I met up with a good friend of mine today. We were talking about money the whole way through, and pensions is, I think don't quote me on it, but it was something like in the 80s, there was 42 people working for every one retiree. Now we're at about 2 workers per every retiree beyond 2030. So how can it be sustainable? Well, it can't be sustainable, surely. Now, again, it's all what ifs. You still got to pay into your employer's pension. You know, you don't have to, but I'm saying still pay into the employer's pension. All I would say really is just meet what they match. So if they put in 4, 5, 6%, meet it, be happy with that, and just let that tick over, because essentially it's free money. So do it. I would also do your own private pension. I've got my own private pension as well. but I don't put heavily into it. I put enough into it that I would be happy if this all pulls through and I get it, brilliant. But I see pensions now as a bonus. Some might go, oh, well, I don't agree with you. You're nuts. You know, the government's fine. But then you're closing your mind off to think that the government's all hunky dory and it's not, you know, it's all legitimate. Well, it's not, because, you know, I say this: if we can print billions and billions and billions and billions and essentially put the country into debt, why are we paying taxes? I said this on another call before. If we can just print money, you know, just why do we pay taxes? Because it's a system, it's an economy. We have to be seen to roll it over and essentially buy out. Imagine if all employees, imagine this, if all employees turned to entrepreneurs and no one went down society, it'd be a total collapse. The government would be in, you know, it would be in a real bad place because they're not getting this consistent income, trying to bail out, essentially chasing this huge amount of debt. So will we end up seeing our pensions 20, 30 plus? I don't feel that we will. And, you know, I think if you rely on your pension, I think you could set yourself up to real failure. You know, I don't want to be living off crackers and, you know, and the real basics when I'm older. So that's why property is a great, you know, fallback, because that could be your pension, you know.
Exactly. And if you own that outright, then you've not got any continued costs to have when you're that age. So yeah, I think you're absolutely right. When it comes to the pensions, it's certainly a worry for myself, having known just that example now, let alone 30 years down the line, where we know that in terms of number of children that the generation before us have had, we are now, there's less of us paying for more retirees, which, like you say, the numbers don't go, the long division doesn't work. It doesn't come into a nice number for us at all.
So what we were saying is that if you look back to the 80s or, you know, 70s, 80s, it was an industrial age, you know, so the turnovers weren't so quick and aggressive. Whereas now we might have an 18-year-old that might create a new tech software that turns over 20, 30 million. You know, it's been done, it can happen. So that's a big pressure on the government, because that's a huge revenue now coming in from essentially nowhere. Whereas compared to the 80s, it would take a lot longer to generate a more industrial type, logistic type of business. So the way that we've got to look at it, I feel, is that, imagine this: if we were all to go to the bank right now, or to your bank, and pull out and say, I want the full lot out, you'd have an argument just to pull out your own money. You know, they'd want to know why you're pulling it out. Well, to me, it's regardless. It's my money. I want all of it out.
Yeah.
They would allow you to do it. So that's a big question. If you can't go to your own bank and pull out every penny you have without having to give a reason, it kind of sparks the question that, was it put in place that, look, you know, if everyone came in here today, you know, we had 10,000 people come in and say, I want to withdraw 30,000, and everyone wanted 30,000, I think the bank would be in a pretty tricky position. So that's the way you've got to look at it. And essentially, are we going to have, you know, there's a lot of conversation and a lot of skepticism about state pension. Are we going to have a state pension after 2030? You know, we're essentially funding the remaining retirement of a lot of the 60 plus right now.
Yeah.
But going past 2030, are we going to have a state pension? So, you know, a lot of people would rely on their pension plus the state pension. So it's just food for thought. It's just stuff that we need to be thinking about. And if you're not thinking about it, then you're being naive, and you're trying to put something very real to the back of your head and believe that the government is spending the finances wisely, because they're not. They haven't done for years. So it's things that we need to put in place now while we're in our early 20s and implement and look long term. I think, like I said, just going back, but just to summarize, we look really short term. We need to look further. It's hard, but we need.
Yeah, the purpose of this conversation is to speak to those people that are already in that space and maybe give them strategy or ideas and places to go to learn more and to continue. But equally, for those people that haven't maybe thought about this yet, it's not to be a scare tactic or to give you a jolt, but it's just to let you know, give you the information that ultimately making investment decisions that will benefit us in the long term, if we make them in our 20s or 30s, we will be in a much better position long term than being reliant on the state pension or maybe a private work pension that may decrease significantly or not be available at all to us in the future. the last area that I want to chat to you about, Aaron, as a busy guy with his own business, his own family life, all about self-development, productivity, making the most of your time. And like you say, you've been very much self-educated as well. What are some of the things that you do to structure your day to be a really productive guy? Because there's going to be things that you do which will be relevant to all of us, particularly if working from home and not going into an office is going to continue post-COVID, which if my company's anything to go by, I think it's going to be the same for many.
Yeah. So just like you, so again, I've brought it up on calls, but it's a big point, and a lot of people overlook it, is health and fitness. You know, for us having that routine, it's about an early wake for me. I've always been an early bird anyway, but it's an early wake. You know, take on the fluids. You know, for me, like I said, like we were saying before the call, you know, all shapes and sizes have their own routine, but for me, and structure and drilling it into me as a habit, the early wake. So, you know, I'm very much that believer of, if you need to get work done, but you say to yourself, well, I haven't got the time, we'll do it when everyone's asleep. Because then when everyone's asleep, you've spent the time that you've wanted to. You know, if you're coming back from work or whatever, spend the time with your family, but then be willing to put in those hours when they've gone to bed. Come back downstairs, open up the laptop and crack on. So I live by that. Early wake, good breakfast, a lot of fluids. You know, I try as much as I can. Obviously, it's a little bit harder during this period, especially if it's raining. You know, it's a lot of grit and determination to get through. Like you do your steps, but to get out on the bike, get my headspace, listen to my audiobook, get my thinking on the go. That's my peak performance. That's another great book to listen to. Peak Performance. That's my peak time where I'm most creative. I'm thinking of good ideas. I'm thinking of my to-do list. And one way that I really eliminate a lot of wasted time is each night, I've done it before we joined the call with yourself, plan out tomorrow morning. So I'll go back up. I don't need to do anything. Tomorrow, my alarm goes off along with 6 others. I wake up. I wake the wife up because the alarms have gone off, right? I go downstairs. I have the coffee. I open up my diary, and I don't need to think. It's all there planned for me. I even put timescales. I give myself a good time scale to do it, and I haven't got to think. I just get on the bike. You know, tomorrow is meant to be a sunny day. I'll head out. I'll do maybe 10 miles, clear head, come back, diary open, and then I just tick off my tasks, and I come back, and then I put those creative ideas. I send the emails that I need to. You know, I'll make the phone calls with a lot of energy. You know, I wouldn't now talk to a client this time of the evening because I'm not going to be, I may not say the right things. I might not be on the ball, you know?
Yeah, to come in on that, one of the things that I loved that you'd written about was you don't make any important decisions after 7 p.m. and that your day is structured, as you've said, around peak performance times. So from what you said there, your peak performance times as an early riser, a bit of an early bird, is early on when other people are maybe still in their bed. You're starting your day to get yourself in the right frame of mind sometimes, but also starting to work as well. So calls, emails are done in the early part of the day where you are the best version of Aaron and the best version of yourself, and you know that you can have that quote unquote peak performance, which is brilliant. And I think many of us can structure our days like that. And although I do know people say that, oh, I'm a night owl, I perform better at night, I know a lot more people who are successful that are early birds, because there is that beauty of no disturbance when it is. And it doesn't have to be crazy early. We're talking like between 6 a.m. and 7 a.m. Most people are still in their bed. So you can do quite a lot during that time, pretty much disturbance free, and serve yourself with a bike ride, a walk, some stretching, hydration, getting some good food ready for the day, whether that's the meal that you have then or meals that you're having later on, ticking those boxes. And I love the idea that you plan your day the night before in your diary. I suppose that when you're tired, or maybe just kind of waking up maybe a bit groggy before the caffeine's hit you from your coffee, or your water's kind of got into your system to hydrate you, you've just got everything there ready for you, and you're like, okay, this is what I'm doing today. I don't need to think about it. I vary my approach on that, and I'm not perfect with that yet at all, because the best days that I have at work when at 4:45, because I'm quite good at having a hard stop at 5 when I'm working at home, because otherwise you can go a bit later. And I'm like you, I perform better early in the day.
Yeah.
I'll write out for the last 15 minutes the calls I need to make tomorrow, the emails I need to send, the webinars I need to log on to, all that kind of stuff. And it means, like you, that I nail that. Whereas the times when I'm working right up to the 5 o'clock bell without thinking about what tomorrow brings, or when I'm chasing my tail a little bit more when I log on in the morning. So I think I'll try and take a leaf out of your book in future, Aaron, and be a lot stricter on it.
And also, you know, like with social media, I do a lot of social media late at night because I don't really find putting posts together takes a lot of brain power. You know, it's just about being a bit creative, putting out something new. And, you know, you can do that laying in bed. You can do that with someone, you know, your other half drops off to sleep. So that I like the social media stuff I'll do late at night. So I'm not putting pressures on myself to make, you know, that I'm hitting 2-3 posts a day. And if the day is planned well and you start hitting those, you know, the endorphins are released from a good morning workout. You're feeling productive. You've had a lot of fluid. I think that's one thing people bypass on a lot is, you know, you'll know this as well, is come down and really hydrate. You know, I'll always have a bottle of water in the fridge. Just come down and, you know, even like 2-3 long swigs, get that fluid back in, and then it makes you alert. Then the coffee, get out, hit the fresh air. And then your brain space, for me, I'm just in this creative mode where, right, I've got to do that, but I can do a bit of a spin on it. I can do this, get home. And, you know, where I've pre-planned the night before, I just go, right, got to do this, boom, do this, boom, phone call there. That's my, you know, musts. And it has a really good effect on you. And then you roll on to other tasks. And for me, my reason is to get it done early as I can to then spend time with my family. And then I'm willing to work again gone midnight. You know, if I need to put stuff together, it won't be hard decision stuff. It won't be complex stuff, but it will be a pre-prep for the following day gone midnight. If I have to, I've got no problem with that.
Yeah, so much interesting stuff within that. And one of the things to pick out that I think we can hit home on is you said you do the stuff and then you roll on from there. And it's that whole principle of momentum. So if your day automatically starts like yours does with a number of different habits and routines that you continue to do. And so many of the listeners will be shouting right now because I love James Clear Atomic Habits, and they'll be like, oh, he's talking about habits again. But that's clearly what you've got. In the morning, you've got a set of habits and routines that come to you naturally, that mean that willpower comes out of it, motivation comes out of it, discipline is there a little bit, but it's really the habit. And you create momentum early on in your day for the first half of your day to be super productive. And it frees up the element of freedom later on in the day to spend with your family, your partner, and to enjoy that section. The last thing that I want to touch on with you, and that you'd spoken about maybe just a little bit there, was you've got your podcast in, you're Audible in. You're always consuming. When are some of the key times that you're taking in information? What are some of the sources that you like to get involved with as well?
So I rarely listen to music, although, you know, there will be stages where, you know, I listen to music. But, you know, anytime I'm commuting, walking, on the bike, in the gym, it's all Audible. You know, Mark Wright is a big Audible guy, audio as well, and he said it was a game changer for him. It's a game changer for me because, you know, I'm coming up to 25 days in total of listening. I'm yet to meet someone who's got a bigger list. I'm sure there is, but I'm yet to meet that person. And it just has been a game changer because all I'm doing is consuming blueprints. I might not want to do every blueprint, but I know about it. I'm broadening my mind to know what possibilities and opportunities I could be involved in. So Audible, and, you know, not everyone has the time. You know, people really like to sit there of an evening and read. You know, I'd rather be planning my next day. But I know I can plan my next day and do a lot of computer work, or I can do my social media, because I know that morning, as I've been making my breakfast and everyone else is still asleep, I've already popped in my audio. I'm continuing to learn about my commodities, my investing. And I think to really peak perform and learn as much as you can, find a good rotation, because if you start to fatigue listening to the same stuff, it's monotone, you know, there's not a good narrator. So mix it up. You know, I go from, give or take, financial, self-development, business, health, financial, I go in that. So I rotate
Cycle.
it. Yeah. So I'm constantly engaged, and it keeps me going. And I'm excited to wake up and listen to my audio.
Oh, I'm the same when it comes to podcasts. I know like what I'm going to listen to. One of the things that I've started to do to try and reduce screen time as well is download the podcast the night before, and it's going to be on for like my morning routine for like the hour or so that I'm kind of stretching, hydrating, and going out a walk. Is download it, and then when I go out, I turn my data off, and then I'm not WhatsApping, I'm not Instagramming, which I can be super guilty of, and I'm just consuming the podcast. So I could do the same with Audible. I could download the book and tune into that and really immerse yourself in it at that time in the morning, which I'm sure again I'll get somebody that's clued up on brains, maybe another doctor on the podcast at some point, and I'm sure at that time in the morning, depending on how well you're feeling and whatnot, you're probably really susceptible to taking information and then repeating it, because the podcast that I listen to in the morning, maybe it's just because it's the ones I like the most, I have the most actionable points that then I can teach on to others. I can make Instagram posts about, I can chat to people like yourself about it and be like, oh, Aaron, I listened to this one, I think you'll like it, here's what I learned, and there's 5 things. Whereas sometimes you listen to something and you think, oh, I don't know if I took that in, whereas the ones in the morning, for whatever reason, I seem to retain them.
You're not overwhelming yourself in the morning, and that's what I like. It's fresh, it's a new day, and that's why I wouldn't try to consume anything too heavy the night before, because you'll also make bad decisions, and and you might not be in the right frame of mind to take on the information that perhaps you're revising, or you've got a speech that you need to make. There has to be a cut-off point. And for me, it's 7 o'clock, and I know that I'm ready to get back into it straight in the morning. And it comes down to structure. And I think if you get your structure and routine right, you'll be on to a win. Whatever you do, it doesn't really matter what you do. So it's a big part. It's a big part for me.
Yeah, I love that message, Aaron. And I think that's as good as any for us to end on tonight. Structure and routine is something that I shout and bang on about all the time. So the listeners will either be laughing or they'll be nodding their heads in agreement. Where's the best place for people to connect with Aaron? All of this will be in the show notes below. So if people are super lazy and don't want to take it down just now, they don't have to worry. Where's the best place for them to go?
You can reach me on LinkedIn, Instagram, or you can direct email me, or you can sign up to the newsletter, which is again just through my bio, the link to my blog on Instagram.
What's the handle again for your Insta, Aaron?
So it's at Nightly Investments. And just to finalise, I know that we're going to mention it, but if it relates to any of your audience, obviously the ebook that I'm going to be releasing on the 27th of July has got a lot of attention at the moment, and hopefully that's going to offer some really good insight for people.
Yeah, and people can sign up for the release of that on your website, can't they, on your mailing list?
Yeah, for sure. Yeah,
superb.
For sure.
I'll link all of that, Aaron. If you're with us at this stage, please take a screenshot, bang it in your Instagram story, tag Aaron, tag myself. And if you haven't left a 5-star review on Apple yet, I'm honestly going to send the people around to your gaff and tear it up. I'll be back to speak to you all again very, very soon.